The best stock to buy right now in December, according to my opinion, is Alphabet. The stock is already up 38%, more than 38% year to date in 2024, outperforming the S&P 500 index. So why do I think Alphabet is the best stock to buy right now? That's what I'll cover in this video, highlighting several factors. I'll briefly touch on the quantum computing breakthrough Alphabet recently announced, but I won't go into too much detail about that because it has yet to turn into a product that's going to be commercially viable for the company, which will generate profits and cash flow. It's a little early for that, but I will cover other topics that makes Alphabet an attractive investment for long-term investors. Let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, Alphabet. GOOGL shares are already up more than 38% year to date in 2024. I've had Alphabet stock rated as my top stock to buy all year long, and I've been updating this every month, reiterating this recommendation because even though the price is up, the profits and cash flow are also up, making it still an attractive valuation for long-term investors. As I shared with you in the beginning of the video, I said Alphabet is still my top stock to buy. I last updated that on October 29th, telling investors that I thought it was a top stock to buy. I'll update this again today, December 11th, reiterating my recommendation, my rating of Alphabet as the top stock to buy right now in December 2024. So of course, the primary reasoning behind this recommendation is because of the business, the fundamentals of the business. The user-generated content business model on YouTube is incredibly lucrative. You're probably watching this video on YouTube, and billions of people every month are actively watching content on YouTube that's not created by YouTube. It's created by individuals like myself, and maybe you that are watching are a creator on YouTube as well. We're using our own imagination, our own effort to create these videos that YouTube gets to benefit from. And we're willing to do this because of the massive audience available on YouTube, the network effects of the massive audience on YouTube. So that part of the business, very lucrative. And then you have the search engine business where Alphabet and Google owns an over 80% market share. And that's the area of the business that, while it's very lucrative and Alphabet generates strong profit margins and revenue from that segment, that's the segment of the business that's also causing the biggest risk for Alphabet stock investors because of the launch of these large language models that threaten to take market share away from Google search. And that's what allowed investors to get this valuation on the cheap for Alphabet starting in 2024. But my argument all year long and has been that it's okay for Google to lose some market share points in that category. Its share was so dominant that you've seen it come under pressure from regulators worldwide, threatening to break up the company and restrict its market availability. And that's attention the company doesn't want. So whether it has 80% market share or 73% market share in search, is not going to hurt the company's negotiating position, its competitive power in that industry, especially if it willingly cedes market share to good competitors. And there's a difference between good competitors and bad competitors. And I'll give you several examples. Visa and MasterCard are good competitors. Pepsi and Coca-Cola are good competitors. Verizon and AT&T are good competitors. They don't hurt each other. You don't see them fighting with each other, lowering prices to try and take market share. So I'll give you some examples of bad competitors. Bad competitors are like Tesla and BYD. In China, they're in a price war, continuously lowering prices to try and take market share, and that's hurting profitability for each of those companies, right? So that's not a good competitive environment. Alphabet if it chooses a competitor to cede market share to, or if it sees that OpenAI could be a good competitor to cede some market share to, it might be beneficial to Alphabet in the long run. And that's been my argument this year. And you've seen that result in a nice share price improvement. The fears over Google's losses in market share to large language models other than its own have been overblown, in my opinion. And they're still overblown, which is why you can still get Alphabet stock at a valuation, a forward price to earnings of just 21. Just 21 for a business that's generating double-digit revenue growth, double-digit earnings per share growth. And if I share with you the cash flow expectations over the next several years, in 2024, free cash flow expected to be $75 billion for Alphabet, jumping to $90 billion in 2025, increasing to $103 billion in 2026, to $117 billion in 2027, and $128 billion in 2028, roughly $10 billion of annual free cash flow increases for Alphabet is what Wall Street analysts are forecasting for this business. And I think these forecasts are reasonable because the company's markets that it's operating in are growing. And I haven't even touched on the Google Cloud segment, which is growing faster than Amazon Web Services, which is the leader in the industry. And now Google Cloud was the latest segment in Alphabet's business to generate profitability. It wouldn't surprise me if it generates several $billion in profitability in the next fiscal year. And then you've got long shots that are coming through the pipeline that have also demonstrated to be quite effective. And that's where I'll get into the news of the quantum computing news. So on Monday, they introduced a new chip called Willow, which solved in 5 minutes a computing problem that would take a classical computer more time than the history of the universe. Wow. Now, it's a little early for me to forecast what this will mean for the business in terms of revenue and profit, but it does demonstrate another point that I've been making about Alphabet all year long, and that is the company's effective innovation capabilities. It continues to innovate its products and make it better and better and better, and continue to deliver excellent customer value. And it's delivering excellent customer value mostly for free, right? Google Search and YouTube, the Gmail suite, the G Suite products, free. And billions of people are using it. And Alphabet's able to do that in a way and still generate lucrative profitability for the business. I didn't even touch on Google's self-driving unit Waymo, which is expanding rapidly, now launching in several new cities. And it's another point evidence that the company's research and development efforts lead to products that customers love, products that customers are willing to spend. Well, I shouldn't say customers, but advertisers are willing to spend billions of dollars because billions of monthly active users are utilizing these products that Alphabet is creating. So for all those reasons, I still like Alphabet as my top stock to buy in December 2024. And also, I do own Alphabet stock. I have owned Alphabet stock, I believe, since 2020, when the crash from the pandemic happened, is when I initially entered into Alphabet shares. So I still like the business. The valuation is still good. Of course, there are risks, right? Those risks that I mentioned from Google losing search engine market share, that is a risk. But my case is that the risks are overestimated by the market. The market thinks the risks are much higher than I believe them to be with Alphabet. And that's one of the reasons why I think this valuation is attractive for long-term investors.
Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.